Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Anthony Guarnieri. Anthony, let's start by giving people an introduction to yourself, what you do, who you are, a little bit of your story, how you got into this.
Yeah, absolutely. So again, my name is Anthony. I've been, and you actually said my name really well, so thanks for that.
Yeah.
And I work with a private real estate group called Group RMC. It's essentially a real estate co-investment group. We've been buying assets since the 80s. The family who started Group RMC is the Massa family. And we started off just a handful of families buying assets in Texas during the savings and loans crisis when nobody wanted to invest there, and we just accumulated as many assets as we could. And it started off just a handful of families, whereas today we're over maybe 700, almost 800 investors or so as our co-investment group. And what started off as something very small, over time today we actually grew quietly into one of the largest landlords in several of the different markets that we're in. We're at about 2.5 billion in assets, 21 million square feet. And my role with the firm is I essentially work with a bunch of different investors just to kind of walk everybody through the deals that we get access to, and help them educate themselves on the actual markets that we're in, and just make new friends, right? So the more we're able to grow our co-investment group, well, the more firepower we have to take down more deals and acquire more property together.
Whereabouts are you guys located?
So the family's originally from Montreal, Canada, and that's where I'm based. And we then moved into the US. So we also have an office in New York. And so those are our two main offices. And then we have some other satellite offices as well. So we have one in Columbus. We just opened up one in Florida, and another one, a very small one in Chicago as well. And our assets, where we're buying our properties, are actually in secondary markets in the U.S. So markets like we're one of the largest landlords in Kansas City, one of the largest landlords in Columbus, Ohio, Memphis. We just actually made our first acquisition in Houston and Jacksonville as well. Jacksonville, Florida was also very recent as well, but very much secondary markets in the U.S.
Cool. I don't know if Houston's secondary market. It's a pretty big market.
It's a big secondary market. Yeah, it's a 9-gateway city essentially.
Okay. All right. Yeah. No, sorry. I'm just busting you a little bit.
Yeah, it's true. Yeah.
So you guys are you're buying these without asking like stupid questions, because we've already had a little brief conversation, and we actually were on the phone I think a couple months ago as well. You're not buying multi residential. What are you buying? What are you guys doing?
So our focus is in much larger portfolios. So going back to how we're structured, again, we are a co-investment group, and it's all about our ability to raise the equity required and to go after the deals that we want to be buying. And the deals we want to be buying are in a much larger scale of $100 to $300 million. So that's our target, and we're focusing on office space. So 100% of what we're buying is from institutions. Office real estate portfolio. So that's 100% of our focus right now.
I'm just like, when we talk about office right now, is that a scary spot to be in? Like, how do you make it safe in doing offices? Because some of my friends are working from home. I don't have a job anymore, but there's a lot of home working. Does that create an opportunity? Does that create a fear? Like, how do you deal with that?
Yeah, well, I mean, look, on the onset, and again, 100% of our assets right now are in office, right? So on the onset of the pandemic, we obviously were a little concerned, but not because we just didn't know where things were going to land, right? So the first thing we did is we ramped up our cash reserves, we lowered our LTV, just to make sure that the properties were cash rich should we have to face any headwinds. The reality is we didn't have to. Our rent collections remained 99% throughout. Our occupancy actually went up throughout the pandemic. And because we were really well capitalized and our properties were just ended up performing really, really well, we were actually able to focus our efforts and our capital, instead of putting out fires, actually in growing and buying from other groups who maybe weren't as well prepared or as well capitalized. So for us, I mean, we're really happy with the way things went. There was no way we could have predicted how well things went. But what I'll say is, and this kind of ties into a little bit our investment philosophy, but if things were not going to go well, like if we were going to have a hard time collecting rent and, therefore a hard time paying mortgages and maintaining the properties, if that was going to happen, we have a really, really big buffer. So because of the price point that we have and our acquisition, our cost basis of the deals that we have, because of how low they are, we could actually go to about half empty. So we could be at about 50 to 55% occupancy across our portfolio and still be in the black, still be able to run the properties, maintain mortgage payments and replenish cash reserves and everything. So for us, that was something that because that we could actually control, right? What you pay for, like as an investor, the only thing you can control when you're making an investment is what you pay for something. Then you can't predict what's going to happen in the future. And that's a big part of it, right? Because we're at such a low cost basis, we were going to be okay should things have not gone well. And now we're because, like I said, because we're well capitalized, we've actually been able to focus our efforts in growing. We've acquired about 5 million square feet of new deals since call it June of 2020, right? We've been trying to gobble up as much as we can because it's a great time to be buying right now. Not a ton of competition out there when you're bidding on assets, and it's even we're getting an even lower cost basis because of it.
So what is your buying criteria? Like, what are you looking for? If you see, like, is it a big skyscraper? What is it that you're looking for in deals?
Yeah, the main thing that drives us is value. So we're not we're not really tied to any one specific market.
Yeah.
What's really going to drive us is value. So what I mean by value is and this is often the case across our portfolio, we often buy or acquire assets from typically end-of-life funds or institutions that are kind of going through like some liquidity issue and they need to sell. In most cases, it's non-economic reasons. So the seller's selling for non-economic reasons, which gives the buyer a lot more buying power, right? And so that's really the main driver for us, okay? So it's really about the cost basis, again, going back to the one thing you can control is what you pay for something. Typically, what we look for is multi-tenant. So we don't like single tenant. We don't do single tenant buildings. So we like a nice diversified portfolio. Again, low cost basis. And also by default, because you got a very low cost basis, your cash yield is very high because you're collecting rent from a ton of different tenants. And because your cost basis is so low, our cap rates are typically in the 7 to 10 cap. And so even at a lower occupancy, we're still able to distribute a lot of free cash flow, a lot of distributions to our co-investors. So those are the main criteria that we look for, and we look for them in secondary non-gateway cities where you don't have, as much flow of funds as you do in the hotter markets like the San Franciscos of the world, like the New Yorks of the world, right?
When I started investing in the US, I did it by myself and had to go through the growing pains of doing that. GlennSutherland.com/coaching. A 12-week coaching program done 1 hour per week over Zoom from the comfort of your own home. Classes are kept to 5 people to be able to answer everyone's questions. Shortcut the process. Make fewer mistakes. Curriculum available at GlennSutherland.com/coaching. Okay, and then so I'm guessing you're buying from people who have syndicated deals, and a typical syndication, they've done like a 5 or 7 year hold and they've run their course, and that's why they're looking to, because you're saying it wasn't necessarily market drivers why they were looking to get out. It was more that it's run its course and they they have basically a deal with the investors for a certain amount of time with the money. Is that what you guys are as well? Are you doing the same thing? Do you have a certain time frame on this?
No, we're essentially perpetual equity. We just want to be good landlords. The main driver of those types of structures, right? Those 5-year, 7-year structures is typically because the manager's getting an exit or a carry or a performance fee, and so they're motivated to sell, right? That's their reason of existence, is to capture that performance fee, not being good landlords. Our goal is really just to be really good landlords. So we, again, get in as low as a cost basis as we can And then we aim to cultivate these assets. We look to increase occupancy, reduce expenses, bump up rents, and make it more profitable down the line. And so, we don't invest in the asset with the idea of selling. We invest in the asset with the idea of de-risking from that asset through distributions and refinances, which is much more in your control as an investor. You could do those, as per, as you see fit, rather than trying to predict 5 years down the line. I'm gonna sell this thing 5 years down the line. Well, what if 5 years down the line is March of 2020, right? Like you can't possibly do that. So that's why we just rather be more. We're not opposed to selling. It's just we'd rather have the price dictate the time of sale rather than the time of sale dictate the price, if that makes any sense. So we like I said, we just aim to be good landlords. We aim to de-risk out of the assets. Typically 7 to 8 to 9 years. Yep. We got all our initial equity back, and we own the asset free and clear, and that asset is generating more distributions, more refinances. And the other thing is, once you have an asset that's generating so much free cash flow, you're gonna sell it and buy what? Like where am I gonna find another 10 cap? Or it's not easy, right? And so that's why we're not huge on selling. And you get to defer that tax bill down the road as much as you can, right? Like that's the other thing, right? The day you sell an asset is the day you really get hit on taxes. We just want to defer that in the future as much as we can.
Okay, so then your investors, they're having to commit long-term money to these projects.
Yeah, exactly. Yeah.
And I'm guessing it's the same sort of thing as a typical syndication where they have to ride this out. There's not a way to get your money out partway through.
Yeah, we often have, well, I shouldn't say often, we do have sometimes investors who, life happens and they know going in that we're perpetual equity, but they need the money. It does happen. And so we facilitate secondary trades. We will, the GP can buy back units. Our other co-investors could often buy back units. So we never want anybody to feel stuck. The idea is that we want to invest, alongside like-minded partners, guys who see, or people who see the long-term benefit, or the benefit of holding real estate long-term, not simply, getting hit with a bunch of transaction costs and selling every 2-3 years in that way.
And being in the office space is a little bit different than what I usually get from most syndicators or anything else. Why office space over doing commercial or over doing multi-res?
So I mean, commercial, I guess you mean by like
like the big industrial buildings.
Industrial. Okay. Yeah. So
or whatever, whichever way you want to go.
Yeah. I mean, look, the bottom line is we're not pigeonholed office. Office offers a very interesting proposition, which is, especially when you're going into institutional quality assets, because you're getting institutional quality tenants, you're getting a diverse pool of tenants. So you never have one tenant that kind of has you by the neck in terms of rent increases. You as a landlord will have a little bit more power if a tenant takes up 5% versus if he takes up 50% of your building, right? So we like that multi-tenant, class A tenant, and office. You have multi-year, 5-year, 10-year, 12-year leases, right? So your revenue is contractual. And when you partner contractual revenue essentially with contractual expenses, like we essentially do most of our assets, we do 10-year CMBS loans. Our third-party property management contracts are 5-year, 7-year contracts. So when you lock in your expenses for 10 years and you have a contractual revenue for X amount of years, your free cash flow becomes pretty predictable. We love that model. We love the predictability of the cash flow. So that's why we like office, and we're not opposed to ever going into residential. Industrial right now is way too expensive. You have to really ride that wave, and that's typically things that we don't like riding momentum. Like that's actually the opposite of what we do. We just look for more quieter markets, more value play. So we don't want to ride that momentum. And similar with multi-res. I mean, it's people have done really, really well over the past couple of years in multi-res because prices keep going up, and it's great. But sometimes they might not go up, right? And so we just don't want to play that personally in that game. But I mean, if ever one day, we see a really nice value play in residential, there's nothing stopping us from going in and buying it. We've done residential in the past.
Yeah, and you mentioned value there. So value add for an office building. What is value add for an office building?
Yeah. So value add for an office building. Well, first, value for an office is, obviously getting in at an interesting price.
Yeah.
Value add is the way we look at it, because we often do sometimes just outright stabilize, 85, 90% occupancy deals at a 10 cap, and there's not much to do but sit back and, just collect your rent checks, right? But sometimes we do also have some deals, like the one that we acquired in Houston, where it's a 65% occupancy. So the business plan there is to lease that up, right? And continue to look to reduce expenses and bump up rents as we go. And we actually picked that up on a really nice, we picked up that deal at a very interesting point when leasing momentum was just skyrocketing. It was like just going up. They leased out of a 500,000 square foot building, they leased 110,000 square feet even throughout COVID, right? So it was really riding a really nice leasing momentum. And the nice thing about real estate in general is when you bring up your occupancy from 65 to 67 to 70, that's essentially, it's increasing the value of the asset, right? So your appraisal is getting higher, you can refinance more down the line and so on. But more interestingly, that's a straight dollar to bottom line, right? So your expenses aren't going up and your cash flow is going up, right? So that's, that's where we create the value. It's just, again, being good landlords and filling up the space. And we've been doing it for many years. So, we do have a track record of doing that. And we're, again, very well known in our markets, which definitely helps us out. But that's the idea, right? Buy at a good price. Make sure that it's low enough so that you don't run out of money, because that's a big mistake that a lot of, especially in the office space, a lot of investors kind of go in thinking, yeah, we're gonna hit this out of the park and it's gonna be great, but then they go razor thin on cash reserves. Yeah, well, you better everything better go exactly according to plan, because it's tough, right?
Yep.
So that's essentially it. That's essentially how we work. We get in at a good price, lease up space, bring up occupancy, increase cash flow, refinance, and then create value for our investors.
Yeah, because it's a lot different than doing the multi-res, like the value add, because you're not in charge of any utilities, probably. I'm assuming some of these are triple net. They're in charge of everything. They're in charge of taxes, the whole ride. So it's just get bodies in there.
That's exactly it.
Yeah.
You need it.
So do you do your own leasing, or do you have a separate leasing company to fill these things in for you?
Third party. Yeah, we focus very much on the deal acquisition and due diligence, and then we'll put third-party managers, CBRE, Colliers, Cushman, whatever. We like to use national companies with boots on the ground, and especially in the US. Like, again, we're originally from Canada. We're still like Canadian based, but Canada's a bit of a different market. The US, man, you can't scale to the level of these national companies. You cannot compete with them. So it's much more economical. They have they already have the infrastructure in place. You plug into it, and now because it's we have a pretty good size. When we go to CBRE and we say here's 3 or 5 or whatever million square feet for you to manage, you tend to get the senior guy or the senior leasing leasing guy or leasing agent or the senior property manager for the building.
Yep.
So you have the best guy. You have the number 1 leasing agent 25 years running your property and filling up your space. That actually adds value. Like how you were asking how we create value. Well, that's a way that we create values. We will get the best guy. And then he fills up the building.
All the different stores and everything. Yeah.
Yep. Yeah.
Awesome. Before I let you go, Anthony, anything you want to say about your company? Do a little self-promote and some contact information.
Yeah, look, I mean, we speak with we have co-investors pretty much all over the world, and it's really about partnering up with the right people. So we're always happy. Again, for us, we're always happy partnering up with the new investors. Seeing it be a good fit. For us, again, it gives us more firepower to go and take on these deals, and in return, investors are getting access to deals that you can't really buy on. You can't really invest in $100 or $200, $300 million deal on your own. So that's why the co-investment group is so powerful, right? We can get together, pool our assets, and go after these massive institutional deals. Deals from, like, we did 4 years with Blackstone, UBS, Hertz Investment Portfolio, a ton of different groups, and so we're always looking for the right people to work with. So if ever there's anybody who's interested, we're happy to get to know them and see if there's any synergy.
So if they are interested, they contact you. Do they contact your website? What was the best way to track you guys down?
Yeah, look, I guess I will give my email address. I guess would be the best way. So it's Anthony at grouprmcusa.com. And yeah, just send me an email, send me a note. Super happy to get jump on a call and go over any questions and just see if there's a good fit.
Awesome. Anthony, thank you for coming on the show. It's an angle that I've never tackled on the show with the office space. So it's very interesting. I like it. It's a lot of, it's nice to take out some of the issues that exist in multi-res with this tenants and utilities and all these little things that you have to deal with. It's a lot less to, it's bigger swoops, but a little bit less headaches, I think.
Yeah, well, they're different, I'll say.
Different headaches.
But yeah, but there's definitely some good value to find, and and so I mean, we're very happy, and I want to thank you as well. I mean, you have a great show. I've been watching them more and more as I got to know you now. So like now I get to see them a little bit more often, and honestly, super great job with I was gonna say the title is perfect because we're essentially Canadians buying properties in the US, right? So I thought it was quite fitting.
Awesome. Once again, Anthony, thank you for coming on the show. I really appreciate it.
Thanks, man.